Hello and welcome. I'm Joyce Blonskij and your host of Brilliance by Blonskij. I'm very excited to share with you a series of 4 interviews I did with Joseph Meyer. These are at the center of all of our conversations today. Our interviews go from finding good paying jobs and how employers can find the best talent, or whether or not now is the right time to get into a new home or just sit tight. We're going to talk about the rising costs of caring for your elderly parents, commercial real estate, and a bunch of other things regarding real estate. We're also going to talk about how much it costs to fill up your gas tank and how much more or less it could down the road. We're going to look at how cloud computing and cloud companies can actually reduce your bill when it comes to the gas pump. And lastly, we're going to take a look at the stock market, and Joseph will weigh in on his outlook on where you should be invested right now. Let me take just a moment to read to you a disclosure and a quick little bio for Joseph Meyer, and we'll get started. Securities offered through Cambridge Investment Research, Inc., a broker-dealer member, FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Blonskij Financial Services are not affiliated. In today's volatile investment community, we all need to be confident of obtaining the most accurate information possible in order to make some very critical financial decisions. We find this valuable information by locating the most experienced individuals in their particular field of expertise. In the field of financial services, there are few who can compare with the level of professional experience and expertise of Joseph Meyer. For nearly 4 decades, he's been personally and professionally involved with the U.S. financial industry. He has literally helped thousands of people find their way through the maze of questions that can arise in an ever-changing financial environment. Meyer has seen good markets turn bad and then turn back up towards prosperity again. Joseph Meyer has the answers that only experienced and common sense can provide. Mr. Meyer has entered the brokerage industry back in the early 1970s as a broker-dealer trainee with the firm of Edwards and Hanley, a member of the New York Stock Exchange. He was employed by a number of top New York Stock Exchange firms as a registered representative, including Edwards and Hanley, Merrill Lynch, Shearson, Hayden Stone, Inc., and Payne Weber, Jackson and Curtis. Meyer has also been a professional insurance agent and a licensed in health, life, disability, annuity coverage with Bankers Life and Casualty Company. He became a self-employed stock market strategist and professional equity trader and went on to become a registered investment advisor. In 1989, Meyer developed his management consulting firm, Myers & Associates, to help with the disposition of non-performing structured assets. Meyer is an industry arbitrator with the National Association of Security Dealers and the New York Stock Exchange. I am so pleased to be able to bring Mr. Meyer to our audience today as we discuss a number of wonderful topics in a series of 4 interviews, from jobs to homes to gas and, of course, the stock market. So please join me in welcoming Mr. Meyer. You're listening to part 2 of our 4-part series. This series is on homes, housing, and elderly care, as well as commercial real estate. So if you're thinking about buying a home, renting, looking for office space, or trying to figure out where to put your elderly parent for long-term care or some kind of care facility, you're going to enjoy this conversation with myself and Joseph Meyer. Another issue that's on a lot of people's minds is whether or not we've seen the bottom in the housing market. And we were talking just earlier about the fact that I've even seen for sale signs go up in my own neighborhood, which really makes me sad, because you hate to lose really great neighbors. But, you know, it's brisk here in California still, the number of foreclosures and people losing their homes and short sales. And yet we have a bulk of first-time home buyers that are kind of nervous, thinking, have they seen the bottom? They hate to buy and then see it drop even further. And then you've got the flip side. You've got all the mortgage brokers saying it's never better. You know, we're flipping houses like crazy. Rates are really good. What do you say, and what do you see for maybe the next 5 to 6 months? What do you say as far as home prices across the country and first-time home buyers? And what are your thoughts on, have we hit the bottom and are we coming back up?
Well, I think, first of all, we have to put in context that the previous boom we had in housing was unprecedented. I think you'll agree, anytime you see housing go up 20% a year annualized for 5 years, it's leading to a very important peak, and I'd even go out further and say it's a very important long-term peak. But I think the other side of the equation that people lose sight of is commercial real estate continues to be very overbuilt. In fact, commercial real estate is so overbuilt, Joyce, that there's 21 square feet on the market for every man, woman, and child in America, which is double any previous cycle. So I think when we talk about the correction we've seen in housing, and I'm not downplaying for a minute that it's not been significant, but I think when we look at the bigger picture of housing literally doubling within 5 years and looking now as to how this bear market in housing is playing out, I still tend to believe we're going to see weakening prices and we're going to see housing hopefully make a final bottom. But I think the next shoe to drop when we talk about housing, even going beyond the mortgage foreclosures that are still out there, and certainly the homes which the banks are carrying on their books, I think the biggest problem is we're going to see some foreclosures and some very large ones when we talk about commercial real estate as well.
Last year, I relocated my office from a affluent area in Roseville, California, out to a quieter area, a little older neighborhood, a little closer to home in Fair Oaks. What was interesting is I kid you not, I spent probably 9 months looking for locations, and what I found in commercial realtors and in the landlords or the trusts, whoever happens to own these properties, is there is a huge, and I mean a giant chasm. It's a disconnect between what landlords are asking for and what the going rates really should be. And I can't even tell you how many landlords I looked at and I said, are you kidding me? I can get it for this 5 blocks away. I mean, there's still this mindset of they want top dollar, and what's even crazier is a lot of these places, their buildings were like ghost towns. There may be one occupant. And I can't help but think, well, maybe they're keeping these buildings empty because they need the tax write-off. I was just blown away at how unbending a lot of these, high-end downtown Sacramento, some out on the different freeway corridors, they were still asking, as of this time last year, top dollar for rent. And I'm thinking to myself, I don't think they've come down much, but how long can that last?
Well, I think they're totally unrealistic. I think when you take a look at the vacancy rates and you certainly take a look at, what is happening in Las Vegas, I think that's a prime example there. And I think what's certainly ongoing in California, there's a lot of vacant space. Go into the malls, go into these strip malls, they see these stores that are empty. They stay empty now for many, many months.
Yes.
In a lot of instances, they've been empty for a year, and in some cases going on 2 years, where they've not been able to secure another tenant. I think we're also starting to see in a lot of these malls the anchor tenants move out and the space remain empty for many, many months on end, where you think another high-end anchor tenant would come in and take the space, but it doesn't happen. So I think what you've just explained is simply the market not marking itself to the market. I think the landlords are totally unrealistic as to what tenants can pay and certainly turn a profit. So I think these rents, when you talk commercially, they have a lot to fall. I think when you talk about housing, it's still cheaper to rent than it is to own. I think it pays to continue to rent and wait out the bottom in housing. I think it's a couple of years ahead of us. I know a lot of people get very excited about these low mortgage rates, but I think more importantly, I think when you look at a mortgage, as you know, Joyce, it's not only the interest rate, it's how much do you borrow.
That's right.
And I think in a lot of instances, housing on balance is still very overvalued. I think in some areas it can fall and fall quite significantly. Now, the Northeast has held up fairly well. even though we are starting to see pronounced weakness in some of the strongest markets in the Northeast. But I tend to believe when the banks finally give up the ghost and they put these houses on the market and they go to auction, they're going to bring very little money, Joyce.
Well, did you see that Bank of America has now got a rental department where they've gotten so many foreclosures and people that have just literally abandoned their homes? Now they, rather than flood the market with, 50 cents on the dollar or maybe even less, now they're turning them into rentals, and they're hiring companies to come in and manage them and take care of them. And so it looks like Bank of America is now in the rental business as well as trying to do mortgages.
Well, I think it was a twofold reasoning. I think these houses were empty. I don't think they were saleable, certainly in this current market. And as you know, once the rules had changed through the Fed and through the money center banks as to what would be allowed for someone to qualify for a mortgage, people, I think, lose sight of the fact it's a lot harder to qualify for a mortgage now than it was 10 years ago.
Oh, yeah, it does. They are. I mean, 10 years ago, you didn't even have to have a wage statement. I mean, that's what got some of these banks in trouble, is you just could write anything down on an application and they ran it through. So they needed to have a come to Jesus, if you will, or come to somebody and get back to really good underwriting instead of just signing the document and letting it fly.
Well, as you know, when you've got a very strong a relationship with banking prior to entering the brokerage business, if you go back to the old days, when we used to speak of a conventional mortgage, you had to put 1/3 of the purchase price down in the form of a down payment.
Yeah, I actually did some underwriting back in the day, and I processed all that and did verifications of employment and verifications of this, that, and the other thing. I mean, it was a long, involved process, and you had to have all your I's dotted and all your T's crossed, or they would basically say, I'm really sorry, but at this point in time you don't qualify for a conventional loan.
And not only that, you had to have a very realistic and fair appraisal of the property.
Yeah. So Joseph, the other day I was talking with someone about the fact that these senior care facilities here in California, I don't know what they are all across the United States, but there was an Alzheimer's dementia facility, and it was a for-profit organization, and they had 50 beds in this facility. And depending on the level of care, and they had 3 levels of care, and each one went up about $500 a month, but the maximum care was $6,000 a month for, full-time care and monitoring them and, making sure that they don't, walk away and get lost and that they're not violent. And I can't help but thinking, as we get older, as our demographics age here in the United States, I'm wondering if those commercial buildings can be converted into warehouses for seniors and aging elders.
Well, I think we have to go on the premise, will Social Security stay solvent? Will Medicare stay solvent? Will Medicaid stay solvent? I think these are questions at this point I don't have a definitive answer to. I think if we continue down the road, and I think you'll agree, of $1 trillion a year budget deficits, there's no question we're in deep trouble.
Well, I don't know if you saw the news lately, but there are a number of state teacher retirements. Illinois comes to mind just recently, that has in the billions of dollars of shortfalls, and they are already starting to have a conversation about reducing the pension benefits to the retirees, because in the past they would say, well, we're talking about reducing the benefits of those that are working, so when they retire they'll know that they're going to have to get less. But now they're actually talking about reducing the benefit of existing retirees, which, that if that happens, that's the beginning of a domino effect.
A lot of people lose sight of a simple fact. When Social Security was formed, we had 7 people paying in for every 1 person drawing benefits. Mm-hmm. We currently now have 3 people paying in for every 1 person drawing down benefits.
Yes.
So we're getting more and more people now with the aging of the baby boomers and their eligibility, certainly to collect Social Security. And when you take a look at the number of eligible people paying in, there's no wonder we have a shortfall every year, Joyce.
Yeah, and I've told people once, I've told them a million times, you need a